When we talk about the most consistent dividend stock in the Thai market, well, the name TISCO really has to be crowned champion.
It really does. For years, yeah.
For years, it's just stood as this pillar of stability. As a specialist in higher purchase loans, especially for those premium segments, and a rapidly expanding wealth management provider, TISCO operates in a pretty tricky environment right now.
Absolutely.
We've got persistent, crushing household debt, forecasts of sharply slowing GDP, and a falling interest rate cycle that, well, usually squeezes bank margins.
It really is a moment of truth for the whole Thai financial sector, I think, and especially for a player like TISCO.
Yeah.
You mentioned the economic headwinds, and they are significant. I mean, we're looking at forecasts for Thai GDP growth slowing pretty drastically.
Yeah.
Consensus seems to be, 1.9% to 2.1% in 2025? And maybe dipping even further to 1.6% to 1.8% in 2026. Now, that's not quite a recession, but it's definitely slow enough to put serious pressure on borrowers' ability to repay and bank loan growth, too.
Exactly. And you couple that with high household debt levels.
Yeah.
That's a systemic risk, right? It affects their poor, higher purchase market. And then the falling interest rate environment, which directly impacts a bank's net interest margin, or NIM.
Right.
TISCO is certainly facing a pressure test unlike anything we've seen in recent history. So the question is, can this capital anchor maintain its legendary, stable, high dividend status?
That's really the mission for us today, isn't it? We need to analyze the fundamentals of TISCO using the latest Q3 2025 data we have to figure out if its underlying strength is sufficient to weather this slow-growth, high-risk economic storm.
Yeah.
We want to know if that financial discipline translates into reliable returns for you, the long-term investor.
Okay, so we've got 5 core areas to unpack. First, the crucial Q3 earnings and valuation. We need to look beyond the headline numbers.
Definitely.
Second, the crucial drivers and risks, where TISCO's quality play and high purchases, well, paramount. Third, their long-term business plan and future outlook, focusing specifically on that aggressive push into wealth management.
Fourth, we'll synthesize the analyst consensus and look really hard at the sustainability of that dividend.
Always key for TISCO.
And finally, we'll place the price and technical context around the target ranges analysts are putting out.
Okay. Let's start by pulling apart that financial statement, then.
Right, let's dive into the cold hard numbers from Q3 2025. So TISCO reported a net profit of 1,730 million Thai baht for the quarter. On the surface, that looks pretty decent, actually. Shows a slight increase of 1.0% year over year and a healthy 5.3% growth quarter over quarter.
Yeah, those QOQ figures do suggest some good momentum.
They do.
But, the bigger picture, the 9-month performance, is where we really see the strategic decision-making kind of take effect.
Okay.
The 9M 2025 net profit totaled 5,017.12 million THB, which actually marked a decrease of 3.5% year over year.
Right.
Now, for maybe any other bank, a YOY profit decrease might signal trouble, but for TISCO, this was largely driven by their planned high loan loss provisioning. Okay. That distinction, planned versus reactionary, that feels vital. Can we maybe elaborate on what that proactive provisioning actually means for you, the investor?
Yeah, it basically means management is being highly conservative. They're looking at the external environment, the slowing GDP, the high debt, and they're choosing to set aside larger reserves now.
Proactively.
Exactly. Rather than waiting for non-performing loans, NPLs, to spike later. So they're sacrificing maybe a small amount of current earnings to buffer the balance sheet against future systemic risk.
Okay.
This is really the essence of their disciplined approach, and it's why, despite that 9M provisioning drag, their capital utilization remains incredibly effective.
And that capital utilization, that's best measured by the return on average equity, right? ROAE.
Correct.
Which stood at a phenomenal 16.6% in Q3 2025. I mean, that's not just a strong number. That's kind of a benchmark figure in the financial sector, isn't it?
It really is.
Shows they generate significant profit from shareholder equity without, excessive leverage.
Precisely. They're using their capital base very efficiently, even while maintaining these massive reserves. And this efficiency, coupled with strong revenue diversification, is key. You saw total revenue expanded by an impressive 10.1% YOY in Q3 2025.
Wow.
And that was supported by growth across all their business groups, which is a real testament to that diversification strategy.
Okay, let's break down the revenue pillars then, starting with the traditional core, net interest income, NII. So NII was up 1.3% YOY and 3.0% QOQ. Now, in a general environment where interest rates are falling, How did TISCO manage to achieve NII growth? That seems counterintuitive.
Yeah, well, this is where their treasury and funding strategy really excelled this quarter. The growth was mainly credited to lower funding costs.
Okay.
So as the market interest rates declined, TISCO was able to strategically reprice their fixed deposits. Remember, deposits are one of the bank's major costs, and reduce their overall cost of funds more rapidly than the corresponding fall in their lending rates. This effective deposit repricing helped buoy the NII, and critically saw their net interest margin, the NAM, improve to 4.88% in Q3 2025. That was up from 4.73% in Q2, according to reports like CIMB Krungsri.
So good internal cost management basically saved the quarter for NII. But, okay, this leads us to the structural problem maybe. We noted earlier that analysts like InnovestX had previously adjusted 2024 NNM forecasts downward due to external factors. Can you clarify that pressure point?
Yeah, that definitely remains a persistent headwind. The downward adjustment you mentioned, about 5 to 8 basis points of the 2024 NMM forecast, that stemmed from mandated regulatory action.
Right.
Specifically, the Bank of Thailand required cuts to the minimum retail rate, the MRR, for certain vulnerable borrower groups.
Okay, and how does that mechanism affect TISCO specifically? I mean, they focus on quality, right?
They do focus on a higher quality customer base in higher purchase, but they're still obligated to participate in these regulatory support measures. Essentially, they're forced to absorb the cost of lower interest rates for some struggling customers, regardless of whether their own cost of funds is falling at the same rate.
Right, so it puts a cap on things.
Exactly. While that deposit repricing helped in Q3, that structural regulatory mandate means there's kind of a ceiling on how much margin improvement they can really achieve from NII in the long term, which, pushes them further toward non-interest income.
Okay, speaking of which, non-interest income or non-NEI, that was the real powerhouse this quarter, wasn't it?
Absolutely.
Expanded significantly by 31.6% YoY and 25.9% QoQ. I mean, this growth seems to confirm their strategic pivot towards fees and wealth management. What were the specific growth engines here?
Yeah, there were really 3 major drivers. First, bank assurance and commercial banking fees were up 16.9% YoY. Now, this is somewhat cyclical. It was fueled by the recovery and growth in new loan volume, particularly the new high-quality car loans we'll probably discuss later.
Right, makes sense. Every new car means fees.
Exactly. Insurance, processing fees. Second, fund management fees grew a strong 11.4% YoY.
Yeah.
That was driven by new fund launches and also significant growth in their Provident Fund business, which reflects the retirement planning needs of their more affluent clientele.
Okay, and the third driver, this is the one that really captures headlines, right? Those specific investment gains, the gains from financial instruments measured at FVTPL fair value through profit or loss, they were quite notable.
They were, yeah. And it gives us a bit of an insight into TISCO's opportunistic investment style, I think. The gains were substantially boosted by an increase in the investment portfolio value, which included profits from the debt-to-equity conversion of Thai Airways, THAI.
The THAI restructuring. So what does that tell us strategically? I mean, is that a repeatable strategy or just a one-off?
Well, it certainly signals a level of sophistication in managing distressed assets. TISCO, like many financial institutions, holds a portfolio of various debts.
Yeah.
Converting that distressed debt into equity when THAI restructured and then realizing a gain on that newly issued equity, well, it demonstrates not just a one-off windfall, perhaps, but sharp timing and opportunistic management of their investment book.
But not repeatable every quarter.
But you're right, it's not something you can bank on every quarter. It's definitely a flavor for Q3 2025 that investors need to sort of normalize for when they're forecasting future earnings.
Okay, so TISCO had a strong Q3 boosted by operational efficiency, like low funding costs and some of those opportunistic investment gains, all while maintaining incredibly low operating costs. Their cost-to-income ratio stood at a very efficient 43.4%.
Yeah, very tight.
And operating expenses actually decreased 0.3% YoY. That's impressive.
This cost discipline is really their foundation. Now, let's look at how the market rewards this picture of quality and efficiency. Because TISCO consistently trades at a significant premium to its peers.
Okay, give us the comparative valuation snapshot then.
Right. As of late August 2025, TISCO's PE ratio, price to earnings, was around 12.01 times.
Okay.
And its price to book value, PVV, was noted at about 1.7 times. Now contrast this with a key competitor like KKP.
Okay.
KKP trades at a PE of maybe about 8 times and a PVV of only around 0.6 times.
Wow. That is a staggering difference. Why are investors willing to pay nearly 3 times the book value for TISCO compared to KKP or, a 50% higher earnings multiple? What's the thinking there?
It really boils down entirely to the market pricing in quality and certainty. KKP is often seen more as a recovery play.
Right, cheaper bet.
It's cheaper, and if the economy rapidly improves, maybe it has greater capital appreciation potential. But its lower PBV reflects concerns over its higher NPL risk profile and maybe just overall volatility.
Whereas TISCO.
TISCO, on the other hand, commands that premium because investors are buying stability, superior risk management, and crucially, the guaranteed cash flow from that high, sustainable dividend. In uncertain times, reliability is, well, priceless, and that 1.7x PBV is sort of the monetary translation of that faith.
Okay, that faith in TISCO's quality is truly tested in their core market hire purchase. Let's shift our focus now to the economic landscape in which they're actually achieving these results.
Yeah, and the industry backdrop is, well, brutal might be putting it mildly. The Thai auto hire purchase market, which is TISCO's bread and butter, it contracted sharply, down about 5.5% in 2024.
Ouch.
And simultaneously, non-performing loans, NPLs, have surged system-wide, particularly for economically sensitive vehicles like pickup trucks.
Ah, the workhorses.
Exactly, where NPL growth spiked nearly 40% year over year as of May 2024. This signals really intense structural pressure on lower and middle-income households.
And regulators are kind of compounding this pressure too, right? The new Bank of Thailand responsible lending guidelines are expected to tighten credit control by late 2025.
That's right.
Forcing every institution to be more selective, even if they want growth.
Absolutely. The regulatory environment definitely demands prudence. But this is exactly where TISCO's disciplined selective growth strategy becomes their competitive moat, you see.
Okay.
While their total loan portfolio was down slightly, about 0.8% year to date, mainly due to large corporate loan repayments, which is actually healthy de-risking in this environment.
Right.
The crucial retail segment, including hire purchase, is showing positive growth momentum.
Okay, but how do you grow in a contracting, risky market? What does selective growth actually mean in practice for TISCO, like day to day?
Well, it means they are intentionally ceding the high-risk volume segments to competitors. They're not chasing market share at any cost.
Right.
They're raising their credit standards and really targeting customers with demonstrably lower default probability, often focusing on new cars and, higher-end vehicles.
Yeah.
And we see the results of this focus. Their new car loan penetration rate has increased significantly. New car loans grew 24% in the first 9 months of 2025 alone.
24%. That's huge in a shrinking market. And they've also tapped into the electric vehicle, or EV, segment successfully. Why is the EV segment maybe a better, higher quality growth area for a bank right now?
Yeah, probably two main reasons. First, the EV segment generally attracts a more affluent customer base. People who can afford new technology often have better credit profiles to begin with.
Makes sense.
Second, the vehicles themselves, the EVs, tend to retain value better currently, which reduces the bank's risk in case of repossession and resale. TISCO identified this transition early, it seems, and leveraged it for growth while minimizing their NPL risk exposure.
Okay, so this disciplined focus must be why their asset quality metrics look so vastly superior to competitors.
They really are the industry gold standard right now. TISCO maintained exceptional asset quality. Look at their NPL ratio. It actually dropped to 2.3% of total loans in Q3 2025.
Dropped.
Yeah, a decrease from 2.41% in the previous quarter. Now consider the contrast. We mentioned a key competitor earlier whose NPL ratio was 4.2% in 2024.
Wow, that's almost double. I want to spend a moment on the implication of that difference. That nearly twofold gap in NPLs, that must translate directly into just colossal cost savings and competitive advantage.
It's arguably the single most important financial nugget in this entire deep dive. Look at the credit cost. So credit cost is the provision a bank has to set aside for potential loan losses.
Right.
TISCO is proactively setting aside provisions, as we said. Expected credit loss, ECL, was 1.4% of average loans in Q3, 1.0% for the 9 months. But here's the comparison that truly matters. TISCO's overall credit cost for 2024 was only around 0.6% of its loan book.
0.6%, and their key competitor.
Their key competitor's credit cost was approximately 2.3% in the same year.
Whoa.
That 1.7 percentage point difference, 0.6% versus 2.3%, that is a massive monetary measure of TISCO's superior risk management. I mean, when you apply that 1.7% saving across their multi-hundred billion baht loan portfolio,
They're saving billions.
TISCO is saving billions of bahts every single year compared to its peers just on lower credit costs.
And that saved money it doesn't just disappear, it goes straight to the bottom line, which can then be distributed to shareholders. I mean, that is the engine driving the stability and the high dividend, isn't it?
Exactly right. It creates this huge competitive moat. TISCO can afford to maintain its high payout ratio because it doesn't have to funnel such a large chunk of its earnings into provisioning the way its peers might have to. This low credit cost gives them incredible financial flexibility and makes their earnings inherently more trustworthy, more reliable.
Okay. Finally, let's just quickly check the safety buffers that really solidify TISCO's position as this capital anchor.
Yeah, the buffers are, overwhelming might be the word. The NPL coverage ratio, which tells you how much capital is set aside specifically for existing bad loans, it's a staggering 171%.
Wow.
That's significantly up from 155% in Q 2025. So for every dollar of bad debt they currently have, they have $1.71 reserved against it. And on top of that, their BIS ratio, the total capital ratio, is robust at 20.9%. That is nearly double the Bank of Thailand's minimum requirement of 11.0%. This capital base is just the non-negotiable bedrock of their dividend sustainability.
Okay, so putting it all together for this section, TISCO is successfully navigating a really treacherous, contracting higher purchase market by intentionally choosing high-quality segments, absolutely dominating in risk management, and relying on its other strong business line, that's Samwang money for title loans, right, to maintain cash flow.
Precisely. That's the picture in lending. #tag3, business plan and future outlook. And that cautious excellence in the lending business is now being paired with a far more aggressive long-term strategic pivot, this massive push into wealth management. This looks like the future growth engine over the next 3 to 5 years.
Right. This plan signals that TISCO knows the lending environment will probably remain challenging and that sustained high margin growth really has to come from fee-based income now. What are the specific targets for this wealth push? Are they ambitious?
They're quite significant, yeah. TISCO aims for 10 to 15% average growth per year. That's in new clients, assets under management, AUM, and revenue from the wealth management business. And this plan essentially started in 2024, so this isn't just a side project. It's really designed to fundamentally change their revenue mix over time.
Okay. What kind of scale are they working with already, and who is their target demographic for this expansion?
Well, they're already pretty substantial. Current AUM stands at about 250 billion THB.
Okay.
And they're primarily targeting the affluent segment. Critically, about 75 to 80% of their existing client base holds over 5 million THB in deposits and investments with them already.
Wow.
So they want to deepen penetration in that segment, while also actively targeting the slightly broader segment of clients with 1 million THB or more. They estimate that's about 130,000 potential individuals in Thailand.
Right. And the strategy, it sounds like it's built around personalization. Tell us more about this hybrid advisory model they're talking about.
Yeah, the hybrid advisory model seemed to be TISCO's answer to both, pure digital platforms and maybe the traditional high street banks. It focuses on combining highly specialized, high-touch relationship managers, the human element of trust, with advanced proprietary technology that provides deep value-added products.
Okay.
The RMs, the relationship managers, are trained not merely as product sellers, but as comprehensive financial and estate planners.
And this is where their new tool, TISCO My Goal, becomes potentially a massive differentiator, particularly in Thailand's rapidly aging society, right?
Yeah, absolutely. TISCO My Goal is presented as a comprehensive financial and estate planning tool, specifically developed to tackle longevity risk. It goes far beyond simple asset allocation, apparently.
How so?
It helps clients model complex scenarios covering funds, insurance, deposits, inheritance planning, but its critical feature, or the one they highlight, is helping clients plan for post-retirement healthcare costs.
That's huge. Planning for healthcare is so crucial in a region with rapidly rising medical inflation.
It really is the elephant in the retirement room, isn't it? The tool apparently offers projections and estimates for costs in both public and private hospital care. It forces clients to confront the question, okay, how much capital do I really need to live comfortably and healthily for another 20 or 30 years, factoring in potential critical illness?
Yeah.
This level of specialized scenario-based planning is what they hope attracts and retains high net worth clients who are genuinely worried about outliving their savings.
And that focus on longevity and trust, it also requires a physical presence, doesn't it? Which leads to this advisory branch concept they're rolling out.
Correct, yeah. They're rolling out these advisory hubs, starting with their HQ branch back in March 2024. These are designed as consultation centers, not just places for simple transactions. They emphasize financial education, expert consultation, lifestyle activities even, really trying to solidify that relationship and justify the higher fees associated with sophisticated wealth management.
It sets up a fascinating contrast, though. TISCO is betting on specialized human expertise and these bespoke tools in what they themselves see as a slowing economy. Yet the CEO remains distinctly, bearish on the macroeconomic outlook, which kind of justifies this conservative approach.
Yeah, the CEO's outlook really provides the necessary strategic foundation for their discipline, doesn't it? On the global front, they see significant trade war risks, notably the potential for those 19% U.S. retaliatory tariffs, which would severely impact Thai exports if they happen.
Big risk.
Domestically, they seem clear-eyed about the continued drag from high household debt and the slow tourism recovery.
And their internal GDP forecast reflects this pessimism. What was it? 1.9% to 2.1% in 2025, slowing further to 1.6% to 1.8% in 2026. I mean, this isn't just a cautious view. It feels like a strategy-defining forecast.
It does. And this bearish outlook is really the rationale for that quality over volume mandate we talked about. It poses a crucial strategic comparison, I think. Will TISCO's approach focused on extending high-quality business through platforms like Somwang and these deep wealth relationships, will that ultimately outperform competitors who might be chasing volume through aggressive digital expansion, perhaps neglecting risk in pursuit of scale, like, say, KKP's DI app targeting retail investors?
Yeah, it raises a key long-term question for our listener, for you. In a vulnerable, low-growth economy, which strategy is likely to generate more sustainable returns? The premium, quality-focused discipline of TISCO, or maybe the cheaper, rapid-scale gamble of some of its competitors?
TISCO is clearly betting that when the economy turns sour or stays sluggish, their superior asset quality will protect earnings while others might get bogged down by spiraling NPLs, #5E3, an analyst view and dividend sustainability.
Okay, now we arrive at the topic that truly defines TISCO's investment case for many. The dividend. But first, let's just temper expectations slightly with the current consensus from the broader analyst community. What are they saying?
Right. The consensus, based on the Investment Analysts Association, or IAA, survey of 14 brokers, is generally pretty measured. The overall recommendation is currently hold.
Okay. A hold suggests the stock is probably fairly priced right now. What's the breakdown of that sentiment? Is it leaning one way or another?
Well, out of the 14 brokers, you've got 9 recommending hold, 3 recommending buy, and only 2 recommending sell.
Okay, so mostly hold.
Mostly hold.
Yeah.
But crucially, the underlying sentiment reported is overwhelmingly bullish at 85.7%, with bearish sentiment only at 14.3%.
Interesting nuance.
It is. It's a nuanced position. Analysts seem to believe TISCO is worth its current price and its premium valuation, and they see little fundamental reason for a significant drop. But maybe the immediate catalyst for rapid price appreciation is absent right now.
Okay, let's anchor this to the target price. What is the consensus target for 2025?
The IAA consensus average target price for 2025 is 100.61 THB.
Okay, right around where it's trading.
Pretty much. The target range is between a high of 111.00 THB and a low of 87.50 THB. And we see specific research views kind of reinforcing this hold but appreciate the quality stance. For instance, Krungsri Securities recommends neutral with a 93 THB target, specifically labeling TISCO a high-dividend stock champion.
There's that title again.
And Yuanta also maintains a trading recommendation with a 100 THB target, so very much in line with the consensus.
Okay, they are called the dividend stock champion for a reason. Let's talk about the hard numbers behind that title. What makes TISCO's payout so consistently attractive?
TISCO is legendary, really, for its high and consistent payout ratio. It typically hovers around 90% of net profit.
90%.
Yeah, they are committed to distributing earnings because their strong capital levels simply don't require high retention for safety or growth funding right now. Their most recent dividend was 7.75 THB per share, yielding an incredibly attractive rate, usually somewhere between 7.5% and 8.0%.
That yield is fantastic, especially in this environment. But the market forecasts, as we discussed, a slight dip in net profit for 2025 due to that stricter credit control and maybe lower NIM. Will the dividend payout remain robust even with slightly lower profits?
Analysts seem to believe the sustainability is entirely intact. Yuanta, for example, forecasts a 2025 dividend of 6.8 THB per share. That still equates to a very healthy 6.8% yield based on current prices, with an interim payout expected at 1.8 THB.
Okay.
And for 2026, the forecast rises marginally to 6.9 THB per share, or about a 6.9% yield.
Right.
So still very strong.
Right. This brings us to maybe the most critical concept for TISCO investors, the quality of the dividend. You know, in a high-yield market, some dividends can be volatile or require aggressive financial maneuvering to sustain. Why is TISCO's considered so much more sustainable, so much safer?
Yeah, that's a great point. The sustainability is really guaranteed by two factors that we touched on earlier, but they're worth repeating because they're so significant. First, their very conservative provisioning strategy. And second, those colossal capital buffers.
Right, the coverage ratio.
We spoke about the 171% NPL coverage ratio, meaning their reserves massively exceed their current bad debt risk.
Yeah.
And their core equity tier 1 capital, the CET1 ratio, is very high at 17%.
And if the CET1 ratio is so far above the minimum regulatory requirement, that money is essentially free capital that can be distributed without impacting safety, right?
Precisely. Unlike some peers who might need to retain capital just to meet regulatory minimums or maybe to build contingency buffers against potentially higher NPLs down the road, TISCO's superior risk management means their capital base is highly efficient and, frankly, over-reserved by regulatory standards.
So the payout is natural.
This strength allows them to safely distribute 90% of their earnings without risking long-term stability or regulatory compliance. Therefore, the high payout is a natural function of their operational discipline, not some kind of forced strategy just to support the share price. And that is what defines a quality dividend. #DV, price and technical context.
Okay. With the dividend acting as such a strong stabilizer, let's look at the price point itself. As of late August 2025, the stock price was 100.50 THB, reflecting that robust dividend yield of 7.71%. This brings us right back to the market premium for stability, doesn't it?
It really does. The stock's higher PE of, 12.01x, and the PBV of 1.7x, they perfectly encapsulate the value proposition. Investors are seemingly choosing to forego potentially larger capital gains from a cheaper, maybe riskier stock in exchange for that assured, consistent cash flow.
Yeah.
TISCO is priced not necessarily on aggressive future growth, but on the certainty of its current high-quality earnings stream.
And what's fascinating is how that dividend is expected to act as downside protection, even against the forecast of slightly weaker profit in 2025. How does that work?
Well, it creates both a psychological and a practical price floor to some extent. As we noted, analysts forecast that 2025 net profit might dip slightly. Yuanta predicting maybe a 7.5% YoY reduction, mainly due to that intentional tightening of credit control and potentially lower M. However, because TISCO is primarily viewed by the market as a yield stock, investors are likely to limit aggressive sell-offs as long as they remain confident they'll continue to receive that high single-digit yield. The price tends to adjust until the yield hits a certain attractive threshold, say 7% or maybe even higher, providing some inherent downside protection. The yield supports the price.
Okay. Now, we must address the technical context, although, as we mentioned, our source material doesn't provide really detailed chart indicators like specific support and resistance levels.
That's right. So the technical analysis here must therefore focus more on the range defined by the analyst consensus, which serves as a pretty powerful guide to current market expectations, I think.
And where does the current price sit within that range?
Well, the current price of 100.50 THB is sitting almost exactly at the center of the analyst's average target of 100.61 THB.
Okay, so if the stock is trading right at the consensus target, that powerfully reinforces that hold recommendation, doesn't it?
It really does.
It suggests it's seen as fairly valued for the quality it offers, implying that the immediate upside for pure price appreciation might be limited, unless, maybe, TISCO surprises the market with higher than expected growth, perhaps from that wealth management division down the line.
Exactly. For the long-term investor who's focused primarily on stability and income, the focus here probably isn't short-term price movement towards that 111 THB high target. It's more about the annual return generated by the high sustainable dividend.
Right.
This makes TISCO potentially a superb defensive asset against broader market volatility, especially in Thailand's currently sluggish economic environment. #tag outro.
Okay, this has been an incredibly detailed deep dive into TISCO. Wow. To synthesize our findings, I think we can say TISCO remains the undisputed benchmark for stability and quality in the Thai financial sector.
I think that's fair.
They are successfully leveraging truly ultra-efficient risk management. You just look at those vastly low NPLs and the astronomical coverage ratios, and they're using that to sustain a premium, reliable dividend yield, even while the economy slows in their core, higher purchase market contracts.
Yeah, and the trade-off is clear, isn't it? TISCO is intentionally sacrificing some aggressive volume growth in the near term to secure its position. That disciplined choice might cost them some short-term profit growth, as we saw projected for 2025, but it seems to be the critical factor securing the long-term sustainability of their market position and, crucially for investors, that high payout you rely on.
Which leads us neatly to our final provocative thought for you, the listener, to consider, based on that strategic comparison we made earlier. Given the rising systemic risks out there associated with household debt and the structural shift in the auto market towards EVs, TISCO's long-term strategy of doubling down on quality growth and specialized financial planning, through tools like TISCO My Goal and their hybrid advisory approach, it's extremely focused.
Very focused.
So will this strategy of deep relationship building and premium service ultimately outperform competitors who are pursuing high-volume growth through aggressive digital expansion and perhaps cheaper pricing? Or conversely, does TISCO risk being maybe too slow, too niche, to capture a younger, more digitally native consumer base in the long run?
It really forces you, the listener, to reflect on your own portfolio priorities, doesn't it? If your primary goal is stability, defensive positioning against economic downturns, and predictable high cash flow, then TISCO's disciplined, quality-first approach might be exactly what you need.
Right.
But if you're seeking more aggressive capital appreciation, that premium valuation might make TISCO a tougher choice right now. You're paying for that safety.
Absolutely. Well, we certainly hope this deep dive has given you all the insights you need to understand the complex, but I think ultimately compelling case for TISCO.